Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. Starting a fresh week, the Australian dollar maintains its bullish bias after Friday's rally now posts its fourth consecutive day, reaching its objective of 67.45 and also posting its highest level since early January against a weaker US dollar, which fell to around 104.8085. Following a softer US non-farm payrolls report, according to the Bureau of Labor Statistics, the much anticipated US jobs report non-farm payrolls showed an increase of 206,000 for the month, surpassing the 191,000 forecast, but falling short of the revised gains of 218,000 in May. However, the unexpected uptick in the unemployment rate to 4.1%, the highest level since October 2021, should grab the Federal Reserve's attention, potentially giving them flexibility to consider cutting their main interest rates from two-decade highs. With the economic calendar light in Australia, market participants will closely monitor key events, including the Fed Chair Powell's speech, US core CPI inflation, initial jobs claims, and the US PPI data. One takeaway is a softer than expected CPI number could pressure the Fed to signal an interest rate cut in September or even open the door to one later this month. So with the topside target claimed at 67.45, traders should be cautious of potential profit taking or even seeing an extension onto 68 cents. Any pullback is expected to find demand in the region of 66.85 or lower to 66.40, and where the bull trend remains intact beneath at 65, 70, 80. After 6 consecutive days, the euro ended higher as the US dollar index, which measures the greenback strength against a basket of 6 major currencies, weakened after Thursday's 4th of July holiday pause. As we look now towards key events for this week, including the US Federal Reserve Chairman Powell's speech from the semi-annual Monetary Policy Report from the Senate Banking Committee in Washington, D.C., along with that with the US core inflation and also the PPI and the initial jobless claims, the markets will be keeping a very close watch to the data, just in case we see a potential rate cut earlier than September, with the door open maybe for this month. Looking to the technicals for the euro, we can see the market is heading higher on towards the level of 108.3040, and a break there will give further scope on to 109, my much preferred target. Any pullback should find support around 107.80 or lower around the base, which is seen now around 106.70 to 107.30. All eyes on dollar yen as it buckles and now weaker against the US dollar as it pulls away from the 38-year high for Japanese yen. And looking at this key level seen at 160 2025, as a break there should give initial move to the downside and possibly test around this trend line, which is seen around 158 25.50. Moving on to sterling, we can see that the market has rallied firmly and now looking towards its next objective around 128.45 to 55 that could lead on to 129. In case of any pullback, immediate support is seen around 127.65 and with bullish opportunity lower around the region of 126 to 126.5. Following the non-farm payrolls, we can see that the precious yellow metal has surged and was the star performer as it skyrockets onto its target seen around 2,390 to 2,400. A slightly overbought case, but nevertheless an ADX trending and also a bullish case married to with the RSI and MACD. I feel that we could see an extension beyond 2,400 and up to around 2,440, where we can see here was a key level back in May and also where we stabbed close to it back in April. Any weakness should find support around 2,378 and a slightly firmer case around 2,366 to 68. Wrapping up with oil, the market has buckled and posted an engulfing candle that could see further indication to the downside. And if so, we could be looking towards the region of 81.5 or down towards this level around 80, 40, 60. With technicals breaking down quite heavily, should limit the upside. Well, that's a wrap. Thank you for joining me. And as always, look out for the interest rate report and I hope you enjoy the great start to the new week.